I'm here to tell you today that Amazon's financials are not what you think they are. So stick with me for the next 10 minutes and I'll explain to you exactly what I mean by that and what that means for the prospects of the share price going forward. So without further ado, let's go over to the computer and I'll show you exactly why their fundamentals are so deceiving. Okay, so last week I did a fundamental stock analysis on Facebook and I explained why I felt like Facebook was probably one of the cheapest big tech stocks that you can buy, particularly in an overpriced market, right? And so alongside computing a discounted cash flow and earnings multiple model for my valuation for Facebook, I also compared their key metrics to the other big tech stocks. And so you can see here that I compared the compounded annual growth rate in revenue for Facebook. I also compared their EBITDA margin, their unlevered free cash flow margin, and their enterprise value to EBITDA multiple. Now, Facebook came out on top on revenue growth, EBITDA margin. They also came out on top in terms of being the cheapest for their enterprise value to EBITDA multiple. And they came third for their unlevered free cash flow margin, right? So they came first in 3 of them and third in 1. So I think that's pretty good going, right? But I think one thing that would surprise a lot of people is just how poorly Amazon appears to do on those same metrics. So apart from revenue growth, where they do perform very strongly with a compounded annual growth rate of 27%, placing them second, they actually come last for EBITDA margin at just 13%. They come last on their unlevered free cash flow margin at between 5 and 10%, and they actually come fourth in terms of their enterprise value to EBITDA multiple in terms of how cheap the company is, right? So on the face of it, if you're comparing Amazon's key metrics and ratios to the other big tech, then it seems like a no-brainer to avoid Amazon and that the investment looks like a poor one. But actually, that's not the case. It's not until you dig further into the numbers until you really realize what's going on. And I think a lot of investors are actually missing this point. So I've created these 2 tables to show you that Amazon is blowing its competitors out of the water in terms of reinvesting into the business and why this is going to drive long-term sustainable growth for the business going forward. So one of the key metrics where Amazon appeared to perform particularly poorly was on their unlevered free cash flow margin, right? At just around 10%, compared with an average between the others of around 22%. But there really is an explanation for that, right? So what is free cash flow? It's cash from operations minus any capital expenditures. Therefore, if a company isn't spending a lot on capital expenditures, then their free cash flow margins are going to be higher. So what I've done is compared the capital expenditures to their cash from operations. So you've got cash from operations in black, and then we've got capital expenditures in red. And then we've got percentages here to show that ultimately what percentage of those cash from operations are actually reinvested back into the business through capital expenditures. So capital expenditures can be seen as a proxy for reinvestment into the business. And if management are good at generating a high return on invested capital, then you can have good faith that the money that they are reinvesting is going to drive sustainable growth in the future. So on average for Amazon, 51% of the cash that they generate from their operations gets reinvested back into the business through capital expenditures. So whether that be investing in their logistics, their infrastructure for their cloud services, or AI and automation, you know that Amazon are pumping money back into the business to try and grow sustainably long term. Now, when you compare that with the other big tech companies, they don't even come close. So Facebook is 36%, Microsoft 26%, Google 34%, and Apple only 13%. And it's not like the majority of this is maintenance capex where it's not really growing the business. When you listen to management on their earnings call, they're very clear that a lot of this investment is driving long-term growth. And once all of the foundations have been made, they can actually scale back massively on these capital expenditures, which then is going to result in a higher unlevered free cash flow margin. So in other words, they'll be able to reduce their cash outflows, therefore increasing their free cash flow, and therefore increasing the present value of those free cash flows, which of course results in a higher valuation for the company. Now, this chart here really puts into perspective just how much Amazon are actually ramping up investment in their own business. So whilst all of the other companies have really plateaued, Amazon's is actually on this parabolic increase. And the important thing here is that this ramp up has really only just begun, right? So between 2020 and 2021 is when we're seeing this massive ramp up. And we've already seen that Amazon have been able to increase their revenues by 30, even 40% a year. And that was before these capital investments. So despite the fact that this is a company that's expected to generate revenues of almost $500 billion in 2021, is still able to grow at 20, 25, even 30% year over year. And because these capital expenditures here have only just happened, we haven't even witnessed the growth that we're going to see for the business going forward yet. That will start to come into play in 2022 onwards. Okay, so that explains why their free cash flow margin is low, but what about their EBITDA margin? Now, another sort of proxy for understanding how much a business is reinvesting in itself is how much they're spending on research and development. So what I've done here is I've compared EBITDA for each of the big tech companies, which is the numbers in black or the positive numbers, and I've compared that with how much they're spending on research and development. In other words, trying to invest money into developing new products, new ideas, and other drivers of growth for the business going forward. Now, of course, EBITDA stands for earnings before interest, tax, depreciation, and amortization. And therefore, this 57 million figure that we see here was actually after subtracting the research and development costs of what we see here of 43 million. So I just wanted to make that clear. But in either case, we can see that research and development costs as a percentage of the remaining EBITDA is actually 86% in Amazon. You compare that with the others, Facebook's is 40%, Microsoft is 30%, Google 50%, and Apple 20%. And again, this just goes to show you how much Amazon is reinvesting into the business. Now, this shouldn't really come as any surprise, considering that Amazon is probably one of the most innovative businesses that there are out there. But when you do put it into perspective, that Amazon's research and development costs are pretty much double their competitors in terms of percentage of their EBITDA. It really shows you that even still, despite the fact that they are such a mature company, they are not focused on profits yet, right? They still have absolutely no intentions of scaling back those investments into the business to allow them to plateau and sort of achieve the greatest profitability that they can. They're still reinvesting into the business to ensure that they continue to grow long term. And in the future, when they do scale back these research and development costs, you'll see that the profit margins of the company increase massively. So then that brings us on to the discounted cash flow and earnings multiple model to allow us to come up with a valuation for Amazon, right? So what is a fair price for Amazon with all of these things in mind? But just before we come on to that, I just want to remind you of a quote by the man himself, Warren Buffett. And he says that it's better to buy a wonderful company at a fair price than a fair company at a wonderful price. And I don't think that anybody can deny that Amazon is a wonderful company. They're constantly reinvesting in the business. They're growing at a ridiculous rate. They're very well diversified. They're definitely a wonderful company. But are they at a fair price? So for 3 to 5 year revenue growth, we've used a figure of 18%. Now, in terms of 1 to 2 year revenue growth, right, so for 2021, we've got an analyst estimate of $476 billion. And you can see that that's taken from Ticker Terminal. There's a slight difference there, but it's more or less the same. And then the same for 2022. $562 billion expected for 2022. And in my model, I've got $562 billion as well. That's 18% revenue growth on the 2021 numbers. And for 2021, we're expecting 23% growth on 2020 numbers. So absolutely incredible growth. For the years 3 to 5, we're expecting 18% revenue growth. So effectively for them to just keep up what they're doing. Now, bear in mind how much they've just actually reinvested into the business in terms of those capital expenditures and the research and development costs that we were just talking about. I think 18% is very, very fair. 6 to 10 year revenue growth, we've gone with 15%, right? Now for gross margin, the average of the last 3 years was 26%. So I've used 26% for 2021 and 26% for 2022. I've then increased it by 1%. Now, 1% increase on their gross margins is very, very conservative. Now, the reason why I've actually factored in an increase in their gross margins is due to an increase in particular business types within their model, right? So Amazon Web Services, for example, we know that they operate at gross margins of around 60%. And Amazon Web Services, or their cloud business, is actually growing at a faster rate than their e-commerce business, which is lower margins. So actually, I think it makes more sense to factor in these increasing gross margins as the company matures and as their higher gross margin businesses actually increase as well. I then increased those gross margins even further up to 28% from 2026 onwards. Now, I honestly think that their gross margins are going to be much higher than that, if I'm being completely honest, but I think that 28% from 2026 onwards is conservative, and I'm comfortable using those figures. Now, for operating expenses as a percentage of revenue, I've used 18%. And then from 2026 onwards, similar to the gross margin argument, I actually scaled that back and I decreased that down to 16%. And again, the reason for that is because I think that as the company matures, even though it's a very mature company as it is, they will eventually start to scale back those research and development costs, which then is going to result in higher margins. Again, going from operating expenses as a percentage of revenue from 18% down to 16% is nothing drastic, right? It's actually very conservative. Now, for free cash flow as a percentage of revenue, the average of the last 5 years was actually 7%. And you can see that I've taken that from here. So what I've done is for 2021, I've used 7%. And then for 2022 onwards, I've used 8%. And then from 2026 onwards, I've used 9%. Now, again, as we was talking about earlier, this is factoring in the fact that they're going to reduce their capital expenditures as the company grows, right? So a lot of the capital expenditures at the minute aren't maintenance capital expenditures. If they were, then we wouldn't be scaling this back. It's the fact that these capital expenditures are actually foundations for the business growth. And once they're laid, we don't have to continue laying them going forward. Therefore, we can scale back those capital expenditures and increase free cash flow as a percentage of revenue. And then for terminal growth and the weighted average cost of capital, we've got 2% and 8.5% respectively. Now, in terms of the valuation from the discounted cash flow model, we get an intrinsic value per share of $3,233. Now, in terms of the earnings multiple model, we're expecting that in 10 years' time, according to our inputs, their net profits will be $175 billion per year. I've then applied a PE ratio of 25 to those earnings. Now, the current PE ratio of Amazon is around 60, and of course that is going to continue to fall as the business grows, right? But I think that a PE ratio of 25 in 10 years' time is fair. Now, that is still quite a high PE ratio for a business in 10 years' time. And I actually think it's probably one of the highest multiples, if not the highest multiples that I've applied in any of my valuations. But of course, this is not a normal business. It is Amazon. We're still expecting Amazon to be growing quite significantly, even in 10 years' time, just because of the amount that they reinvest into the business. And also, it is just a behemoth, right? It's hard to see any world where Amazon is not continuing to grow. So of course, investors are still going to pay a premium for such a solid business. So I think a PE ratio in 10 years' time of 25 is probably fair. Now that gives us a price per share in 10 years' time of $8,500. And when you discount that back to today using the weighted average cost of capital, it gives us a share price or an intrinsic value of $3,900. We take the average of the two and we get an average estimated intrinsic value of around $3,600, which is around a 3.5% margin of safety. In other words, at the moment, Amazon is fairly valued. But the thing with Amazon is that pretty much over its entire life, it has continued to outperform what analysts are expecting and actually what people believe is possible. So it brings us back to Warren Buffett's point, which is that it's better to buy a wonderful company at a fair price than a fair company at a wonderful price. So that's my valuation based on the discounted cash flow and net income of the business in 10 years' time. And then I've also come up with a 2025 price target based on what I believe the EBITDA is going to be in 2025 and applying an enterprise value to EBITDA multiple to that. So we said that the 2025 revenue is going to be just shy of $925 billion, and that is taken from the model that we just went through. Now for the EBITDA margin, I've gone with 18%. And you can see here that the EBITDA margin in 2020 was 15%. In 2022, we're expecting it to be 16%. And then according to my model, I'm saying that by 2025, that EBITDA margin would have increased to 18%. So effectively, it's coming to the fact that their margins are increasing due to high margin businesses such as Amazon Web Services, and then also coming back to the point we were making earlier, that they'll be scaling back their sort of investments in their research and development, which will of course increase their margins as well. So I think going from 16% in 2022 is what we're expecting, up to 18% in 2025 is relatively conservative, and I think it's definitely possible. Right, that gives us an EBITDA, and not only possible, I think it's probable. That gives us an EBITDA in 2025 of $166 billion, and I've applied an enterprise value to EBITDA multiple to that of 22. Now, in terms of how I've come up with that number, I've looked at historically over the last 3 years, how much have investors been willing to pay as a multiple of their EBITDA, right? So over the last 3 years, the average was a multiple of 33. We saw highs of 49 and lows of 23.5. So I've tried to be conservative, and I've said that in 4 years' time, investors will actually be willing to pay less for the business as a multiple, and therefore I've applied a multiple of 22. That then gets us to a 2025 enterprise value of $3.6 trillion. And then the current shares outstanding of 514 million, and I'm expecting that they are going to continue to issue shares as they historically have done and increase their share count by around 1.5% per year. Now the average for the last 5 years has been around 1%. So again, I'm saying that their shares are actually going to increase at a quicker rate than what they have been doing previously, which again is a more conservative assumption. And that gives us a 2025 price target of $6,600 and a compounded annual growth rate of 17%. So a compounded annual growth rate of 17% for a company, when you compare them to the other big tech, look like they seem to be performing the worst in terms of pretty much every metric that we looked at. It just goes to show you that you have to actually dig into the numbers a little bit deeper and understand the business before you can actually come up with a full valuation. So I hope you found that useful, guys. And until next time, thank you.